is technical analysis. Technical analysis is the study of price movements based on what has already happened. When you are performing technical analysis on a currency, you are looking for patterns on a chart that repeat themselves. The basic belief is that because price movement is dictated by humans, the patterns will continue to repeat as long as humans run the market. Humans make repetitive actions based on repetitive emotions, and those repetitions can be analyzed to predict price movement. Technical analysts study trends, support and resistance levels, and Forex indicators to forecast the direction in which a price is going to move. You can use these factors to your advantage, since when you know what signals to look for, you can time your trades in the best way possible to make a tidy profit. Forex charts. Forex charts are the basis of technical analysis. They provide the information traders need to evaluate and manage currency movements. Monitoring currency movements is critical if you want to be able to time your trade to maximize your profit. You will need to study price quotes over a single day, several days, a month, several months, and even several years. This will allow you to get the overall picture of a currency's movement. You won't be distracted by abnormal fluctuations. You will want to learn how to analyze chart patterns that represent price movement. At that point, you can then apply the technical indicators you have chosen to use and be able to make a successful trade. If you didn't get these live feeds on the charts, you would be trading blind, which is never a good idea. Support and resistance. Technical analysis relies on support and resistance more than any other concept. Essentially, it means that the movement of a price will stop and reverse at certain levels. Resistance is the top level of a currency that the price will reach but not break. Support is the bottom level of a currency that the price will reach but not break. Usually, a price moves between support and resistance levels, which allows traders to buy a currency at support when it's at its cheapest and sell it at resistance when it's at its most expensive. When you are trying to determine entry and exit into a trade based on support and resistance levels, you will want to select a Forex chart that shows a price interval period that is in line with your trading strategy and time frame. If you are trading short term, you will use a 1-minute or 5-minute chart. And if you are trading long term, you will use an hourly, daily, weekly or monthly chart. When you are analyzing support and resistance, you will take indicators into account to determine when a trade is going to reverse. Breakouts. Breakouts occur when prices pass through support or resistance. Your job during technical analysis is to try to predict when a breakout is going to happen. There are 3 types of chart breakouts that happen most often. A breakout that comes after a period of price consolidation, a breakout that comes after a period of narrowing price variation, and a breakout that comes from within a rising or falling trend. Breakouts happen because of the varied opinions of what traders believe fair value is for a specific currency. Traders will cause the price to move up and down, hitting levels of support and resistance, but eventually one side of the trade is going to win, causing the price to move past either support or resistance and take the currency higher and lower. A breakout is usually the start of a new trend. The key to profiting on a breakout is to use technical analysis to predict when a breakout is going to occur and time your trade at the start of the breakout. Price trends. Forex price trends are simply identified price movement patterns. When you watch prices over a time period, you will begin to see patterns emerge. You can examine these patterns and learn to predict price movement. Your goal is to identify a price trend as early as possible, make your trade and then exit your trade as soon as the trend starts reversing. Remember that you are using past price movements to predict where the price is going to go in the future. You are making assumptions that a price is going to move in a specific direction. your assumption could very well be wrong. However, the better you get at technical analysis, the better your odds are of making a correct prediction based on price trends. You need to expect that you will make some losing trades, but if you learn from them, you can make better trades in the future. Trend lines. Trend lines are used by technical analysts to determine entry and exit trading points. Trend lines are formed by drawing a diagonal line between at least two price points. A support trend line is drawn below the line between points of support, and a resistance trend line is drawn above the line between points of resistance. The goal when using trend lines is to buy a currency at support and sell at resistance. The reason for this is that when the price goes back to a trend line, you might have a chance to open a new trade in that direction if you believe the trend line is going to continue in that direction. Analyzing trend lines also allows you to better pinpoint breakouts, when you should place a trade in the opposite direction of the existing trend, and close trades that are in the direction of the existing trend. Time frames. The time frame refers to the type of chart you are analyzing. For example, if you're analyzing an hourly chart, you're looking at prices over each hour. However, for technical analysis purposes, your hourly chart might cover several days, weeks, or even months. You will simply have a price point at each hour to analyze. This is the way in which an analyst can look at the Forex market and identify long-term trading opportunities. It is often recommended that you study long-term timeframes first and then move to short-term timeframes as you get deeper into your analysis. On long-term charts, you are going to see less movement, so there will be less to distract you. As you move closer to the minute charts, you will start to see a lot of movement and you will have much more information to study. Fibonacci retracements. Technical analysts use Fibonacci retracements to predict the length of corrections during a trend. They are expressed in percentage values, where 38.2%, 50% and 61.8% are the most popular retracement levels for Forex trading. Fibonacci retracements are named after the mathematic sequence that was discovered by a 12th century mathematician named Fibonacci. The sequence has been found in numerous situations in nature and essentially says that each successive number is the sum of two numbers before it. So, in a sequence 1, 1, 2, 3, 5, it would mean that 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, and so on. Any number is about 1.618 times the previous number. If we divide a number by the number 2 places to the right, we get a ratio of 0.382. This is where the percentages 38.2 and 61.8% come from. Since Forex is the biggest market in the world, it is the market that comes closest to operating as a natural mechanism. Therefore, the way it behaves can be explained by laws that work in other natural situations. For this reason, Fibonacci retracements work well in technical analysis. The larger currency movements are naturally going to be followed by corrections of 38.2%, 50% or 61.8%. Currency prices will retrace a minimum of 38.2% in a strong trend. In a weak trend, corrections may trace as far as 61.8%. The 50% retracement level is the most commonly monitored level and is where many traders buy during uptrends and sell during downtrends. To draw Fibonacci retracements, you will want to calculate the pip distance between several recent high levels and low levels. Then, you need to find the percentage of this distance which corresponds to each retracement level. For example, if you have measured the pop distance at 200 pips, 38% of 200 would be 76 pips, 50% of 200 would be 100 pips, and 61.8% of 200 would be 124 pips. Then you would need to subtract those pip numbers from the high point of an upward move, or add them to the low point for a downward move. Most Forex traders use a combination of technical analysis tools and Fibonacci retracement to confirm their predictions. When more than one indicator is telling you the same thing, you will want to listen and make your trade. Benefits of technical analysis. Traders who trade solely on technical analysis believe there is no way to reliably trade on news the way that fundamental analysts attempt to do. Fundamental analysts believe that technical analysts are behind the times because they are analyzing what has already happened instead of what will happen. They believe that the news is the only thing that moves the market. It is up to you to decide which camp you fall into. However, here are some benefits to using technical analysis to make your trades. Firstly, you will be able to pinpoint entry and exit points, which is difficult to do if you are simply waiting for news to be announced. Analyzing charts will allow you to identify trends at the same time as other traders, since everyone is watching the same data. This means that because of the large number of Forex traders that are analyzing the same information, they can actually create a self-fulfilling prophecy by making prices go in a certain direction. Charts and indicators have been around since Forex began, and traders have been using them to make profits for that entire time. If they didn't work, it would have been discovered long ago. In fact, you can use charts to plan your profits and losses with much more accuracy than you can if you trade on news alone.